But you can measure it back a decade and you see it's going up 60% a year, and it's 60 volatility. It's a 60 vol against the dollar. So you should think of Bitcoin as an asset. It's like you're on a speeding train going 60 miles an hour, and you've got a flywheel spinning 60 RPM. And the pedestrian on flat land is standing on the plane watching the train go by, thinking this is scary. It's going to suck the oxygen out of my lungs. And they're thinking my money isn't an asset because it goes up 0% a year. So they have a different view toward money than the view of someone on the Bitcoin train. The person with $1 million of cash is going to have $1 million of cash in a decade. A person with $1 million of Bitcoin is going to double their capital every 18 months if they just hold on to it, right? And so they're going to double it once, twice, three, four times at that rate, right? The volatility
But this really
itself,
does come down to, sorry, and I'll let you get back to that,
yeah.
but this does come down to a belief that when you look into the future, that the setup that makes it have the 60% ARR is going to continue. Because I look at this and I say the only reason that it has that kind of reward is that it is volatile, that there are question marks. Because if there were no question marks, everyone would flood in near instantly. It would hit homeostasis, and that would be that. So I think Bitcoin is anything but risk-free, but I do think that the volatility is advantageous for the people who are going to be right if people are right about the upside. That's the most fair way to say it. Why do you think the best way to conceptualize this is as risk-free?
Howard Marks would say volatility is not risk. Volatility is volatility, right? A merry-go-round, or a carnival ride or a roller coaster is volatile. The risk part is if you fly off the roller coaster, right? If the merry-go-round stops working, etc. So the fundamental risk of Bitcoin is the existential risk of an extinction level event and Bitcoin, right? If space aliens come down and say, we're taking your Bitcoin away from you, right? Then I guess there's risk. If some evil genius finds a way to create a cyber virus that infects and destroys the Bitcoin network instantly, irrevocably, that is the risk. So, but that's kind of like that's the existential risk you take when you get on the airplane. If it crashes, that's the existential risk you take when you cross the street. That's the existential risk you take when you put a piece of food in your mouth. And I say, and you say, well, can you imagine that hurting me? And I say, yeah, if I put poison in the food, you're dead. Okay, so do you trust me? Do you trust the waiter when you put the food in your mouth, right? So yes, there is some risk in life. And the existential risk is that extinction level event.
You don't think there's another layer of risk in that, not existential, because you're saying the risk-free return of Bitcoin is 60%. But I think there is, it seems strange to me to not allocate some percentage of, maybe it doesn't grow that fast. Maybe it doesn't remain 60%. You yourself say over the next, 21 years, it's going to come down. It'll average out over about 29%. What if that accelerates and the return ends up being substantively less than that? So I get saying that this has a better chance of having a higher annual rate of return than, say, the S&P 500, which maybe we clock at 15%. We say, we might not hit 60%, but we're probably not going to drop below 15%. Therefore, if 15% is our hurdle rate, it's going to be something north of that. But I think where people trip up with your language is this idea of the inevitability of the 60%. What would you say to that?
So we're dealing with three concepts: risk, volatility, and performance. Okay, so I've addressed the risk issue by pointing out that there is existential risk in your given network or frame of reference. And I just want to make that point that once you understand that risk of being in that frame of reference, then you have to figure out what's the source of the volatility and the performance. And if you don't understand why the asset does what it does. If you don't understand the economic physics involved, then you'll think it's random, and you'll feel like the performance is risky. But I want to give you an example of a physical metaphor. I'm a hiker and I come across a mountain lake, and the mountain lake has 500 trillion gallons of water in it. And yeah, I don't know how it got there, but it's there. The water's chilly, it's clear. And I look down and there's a waterfall coming off the mountain lake. And the waterfall, it's very beautiful, and it's very turbulent, right? Water is turbulent in a waterfall. Water is not turbulent in a glassy lake. So the turbulence is volatility, right? And there's waterfall. And then I look at it, and now if you look and you say, I don't know why that water falls downhill. I don't know if it'll keep falling downhill, but I hate the volatility. Then I guess you can take a selfie in front of the lake, go swimming, get cold, and leave. But let's say you're not a tourist, but you're an engineer. So you come across the same lake and you see the waterfall and you see the 500 trillion gallons, and you think about gravity and you think about sunlight. And now I know how the water got there. The water got there because the sun shone on the ocean. The water evaporated from the ocean. It rose up in the clouds. The wind blew it against the mountain. It condensed and it rained into the mountain, and the water ran off the mountain into the mountain lake.